Hello and welcome to Market Brief After Hours. It's great to have you with us as we unpack a session that felt a bit like a reality check for investors. We've been riding high on earnings optimism for weeks, but Thursday saw the market take a pause, look around, and ask some tough questions about valuations.
That's exactly right. It was a day defined by reassessment. We saw momentum cool significantly across U.S. equities. The catalyst really was the aftermath of Nvidia's results. Even though the numbers were strong, the reaction was a sharp sell-off, and that heavyweight tech weakness dragged down broader sentiment. It wasn't a panic, but it was definitely a shift into a prove-it mode. Investors are looking past the headline beats now. They are scrutinizing guidance and valuations with a magnifying glass.
Let's get straight into the numbers, because it was a mixed bag depending on where you looked.
It was. The S&P 500 pulled back, closing at 6,909. That's a loss of 0.54%. The drag there was undeniable. When the semiconductor sector catches a cold, the S&P sneezes. We saw investors adopting a very cautious stance, specifically around AI-related growth. The expectations were sky high, and the sentiment turned skeptical very quickly.
And the tech-heavy Nasdaq took the brunt of it.
Absolutely. The Nasdaq composite slid 1.18% to finish at 22,878. It wasn't just Nvidia. That post-earnings slump triggered a retreat across the entire chip industry. We also saw the software sector looking fragile. There are these ongoing fears about AI disruption eating into margins, and that nervousness was front and center.
But the Dow Jones managed to buck the trend, didn't it?
It did, barely, but it ended in the green. The Dow Jones Industrial Average edged higher by about 17 points, or 0.03%, to settle at 49,499. This is where we see that sector rotation story playing out. While tech was selling off, money was moving into financials and energy. Those sectors provided a necessary buffer. We saw names like JP Chase and CBRE Group putting in solid shifts to keep the index afloat.
It's interesting to see that rotation. It suggests investors aren't leaving the market, they're just moving the furniture around.
Precisely. Risk appetite hasn't eroded, it's just become more selective. And we saw that disconnect even more clearly when we look across the Atlantic. While the U.S. was fretting over tech valuations, European indices were actually gaining ground.
That was surprising given the economic data coming out of the Eurozone.
It was a classic case of markets ignoring the macro to focus on the micro, specifically corporate earnings. The Eurozone economic confidence data actually missed forecasts, dropping to 98.3 in February. But the market shrugged that off. The FTSE 100 in London climbed 0.40% to 10,850. The CAC 40 added 0.72%, and the DAX in Germany was up 0.45%.
So bad economic news, but good market performance?
Exactly. Even though business lending is decelerating, ECB data showed it grew at only 2.8% in January. Investors focused on individual corporate stories. For example, Puma shares surged over 9% despite a decline in annual sales. It's all about forward guidance right now.
Let's swing over to Asia before we take a break, because Japan seems unstoppable at the moment.
Japan is the standout story globally right now. The Nikkei 225 briefly crossed the $59,000 mark for the first time ever. It trims those gains slightly to close at 58,753, but that's still a third straight session of record highs. There is a narrative driving this called the Takaichi trade, linked to the appointment of dovish central bank board members. Investors are betting that monetary policy will remain supportive.
And South Korea had a massive day as well.
Huge day. The Kospi surged 3.67% to 6,307. That was largely driven by the Bank of Korea holding its base rate at 2.5%. The market loved that stability. On the flip side, Hong Kong lagged, with the Hang Seng sliding 1.4%, but generally the Asian session was very strong.
We are going to take a very short break. When we come back, we are going to dive deep into the technicals, specifically the Forex markets and those moving averages you need to watch, plus a look at commodities and the biggest single stock movers of the day. Stay with us. Welcome back to Market Brief After Hours. Before the break, we talked about the equity indices, but I want to get into the currency markets. There were some significant technical moves on Thursday, particularly for the euro and the pound.
There really were. If you look at the FX dashboard, we are seeing some trends being tested. Let's start with Euro USD. The pair edged lower by 0.07% to close at 1.1802. It's easing back from recent highs, but the technical structure is fascinating here.
It seems to be holding on to its support levels, though.
It is. Despite the selling pressure, the price remains above all the key simple moving averages, or SMAs. It's sitting above the 50-day SMA at 1.1776, the 100-day at 1.1692, and the 200-day at 1.1659. As long as we stay above that 50-day line at 1.1776, the medium-term bullish structure is intact. This looks like a corrective retreat rather than a reversal. But if we break 1.1829 on the upside, we could see a run toward 1.1900.
The picture looks a little more fragile for sterling, doesn't it?
Much more fragile. GBP USD fell 0.50% to close at 1.3492. The momentum has clearly shifted lower in the short term. The pair actually slipped below its 50-day SMA, which is at 1.3537. That is a bearish signal.
So where's the safety net for the pound?
It's getting tight. It's still marginally above the 200-day SMA at 1.3445 and the 100-day at 1.3395. That 1.3445 level is critical. If we get a sustained break below that, we are looking at a much deeper pullback. We've been seeing lower highs forming since early February, so the pressure is building.
And quickly on the yen?
USD JPY is holding firm. It eased slightly to 156.13, but this is just consolidation. It is comfortably above the 50-day SMA at 155.99. The long-term structure is firmly bullish, with the 200-day SMA way down at 150.86. Unless we break below 155.70, the bulls are still in control here.
Let's touch on the economic data that came out in the U.S., because that plays into these currency moves. We had jobless claims numbers.
We did. Initial jobless claims rose slightly by 4,000 to 212,000. But to put that in context, the consensus estimate was 215,000. So we are still coming in under expectations. Layoffs remain historically low. Perhaps more importantly, continuing claims dropped to 1.833 million.
So the labor market isn't cracking yet?
Not at all. It suggests that while hiring might be slowing down broadly, companies are holding on to the workers they have. The 4-week moving average barely budged. This stability helps explain why Treasury yields drifted lower. The 10-year yield slipped to 4.01%, and the 2-year eased to 3.438%. It's a sign of modest defensive positioning as investors wait for more data.
Moving to commodities, gold seems to be the quiet achiever recently.
Gold is acting like a steamroller. It rose 0.77% to settle at $5,199. It's consolidating near record levels. The technicals here are incredibly strong. The price is trading way above the 50-day SMA, which is down at $4,757.
That is a massive gap.
It is, and it reinforces the dominant bullish trend. The $5,000 level is acting as a psychological anchor. Every dip is attracting buyers. Silver had a wilder ride, slipping 0.44% to $88.83, but it rebounded sharply from a low of $85.25. That long lower wick on the chart tells us there is strong buying interest at lower levels.
And oil?
Oil is being batted around by headlines. Brent crude slipped slightly to $70.75. It's all about the U.S.-Iran nuclear talks right now. Traders are reacting to every headline regarding enrichment demands. It's keeping the market volatile, but prices settled slightly lower.
I want to wrap up with the market movers, the specific stocks that made big waves. We saw some massive jumps on earnings.
We sure did. The casino and gaming group Penn Entertainment was a standout. Shares surged 17%. They posted revenue of $1.81 billion, beating the estimates. It shows that despite the economic caution, the consumer is still spending on entertainment.
And in the tech space, IonQ had a great day.
IonQ soared 22%. This is a quantum computing play. Their sales outlook was very upbeat, forecasting Q1 revenue significantly above expectations. When you're in a nascent industry like quantum computing, guidance is everything, and they delivered.
FinTech had a win too with Chime.
Chime Financial rallied more than 13%, stronger than expected revenue, and again, upbeat full-year guidance. It highlights that growth momentum is still there for the right companies.
But it wasn't good news for everyone. Real estate finance took a hit.
Walker and Dunlop was the cautionary tale of the day. Shares cratered nearly 20%. They issued downbeat full-year earnings guidance. In this environment, if you tell the market your future earnings are going to be soft, the punishment is immediate and severe. Procept Biorobotics saw the same thing, down over 15% after projecting revenue below consensus.
It really ties back to your opening point. The market is in a prove-it mode. If the guidance isn't there, the investors walk away.
Exactly. Confidence is conditional right now. Investors are willing to rotate sectors, but they aren't willing to blindly trust valuations without the earnings momentum to back it up.
A fascinating session and plenty to keep an eye on as we head toward the weekend. That brings us to the end of this episode. If you find this useful, please follow Market Brief After Hours on your preferred platform so you never miss an update. Thanks for listening.